Here's something that will flip everything you think you know about investing. The most dangerous investor in the market right now isn't the one doing too little. It's the one doing too much. See, we're wired to believe that action equals progress, that busy hands build wealth, that checking your portfolio, tweaking your allocations, reacting to every single headline, that's what serious investors do. But I'm going to show you today why that belief is quietly destroying more retirement accounts, more nest eggs, more financial futures than any crash, recession, or bear market ever could. And more importantly, I'm going to show you the exact framework the greatest wealth builders in history used to protect what they built, by doing something almost nobody talks about: waiting. Not passive waiting, not frozen with fear waiting, watchful, disciplined, weaponized waiting. And by the end of this, you're going to understand why the big money, the real generational money, is never made in action. It's made in patience. Now look, I've spent over 25 years studying how real wealth gets built. Not the flashy kind you see on social media. Not the crypto crowd celebrating on a Tuesday and panicking by Thursday. The quiet kind, the fortress kind, the kind that compounds silently in the background while the speculators are busy burning themselves out. And the one name that keeps surfacing again and again across every market cycle I've ever witnessed is Warren Buffett. Here's the thing about Buffett that most people completely miss. They see the billions and assume he's some kind of genius stock picker, some wizard with a Bloomberg terminal and a Rolodex full of Wall Street tips. That's not the story. Buffett bought his very first stock in 1942. He was 11 years old. 3 shares of Citi's Service Preferred at $38 a share, money he'd saved doing odd jobs around Omaha. And by 1958, when most of his neighbors were buying new appliances on credit and living large on post-war optimism, Buffett was quietly paying $31,500 for a modest house in Omaha. That's roughly $335,000 in today's dollars. He still lives there, and he was plowing every other available dollar into his investment partnership. Not spending, not upgrading. Not signaling wealth to anyone, just compounding. Then in 2008, when Lehman Brothers collapsed, when the entire financial system looked like it was coming apart at the seams, most investors were selling, frantically, emotionally, desperately. Buffett was buying. He deployed $5 billion into Goldman Sachs. He wrote an op-ed in the New York Times that October, "Buy American, I am." He was calm, steady, patient. And he walked away from 2008 with positions that multiplied several times over in the following decade. That's the entire lesson in 4 words. Patience is the strategy, not a personality trait, not a nice-to-have virtue, a weapon. And today, I want to show you exactly how to pick it up and use it. The compounding interrupt. The first thing I want to talk about is something I call the compounding interrupt, because here's what nobody tells you. Compounding isn't just something that happens passively to your money over time. It's something you can break. You can shatter it in a single afternoon just by picking up your phone at the wrong moment, the frenzy tax. That's the real hidden cost of hyperactive investing. Every unnecessary trade you make doesn't just cost you the trading fee. It costs you the compounding return on that capital for the next 20 years. Think about that. That's not just money lost, it's money that never gets born. I've watched people treat their portfolios like they're playing a video game, watching tickers every hour. Shifting allocations based on a CNBC headline, selling a position on Wednesday that they bought on Monday because the market dipped 3%. And here's the brutal truth. The speculator does this and feels smart, feels in control, feels productive. The investor knows that every time you touch a portfolio unnecessarily, you're not protecting it, you're damaging it. Damaging it. That's the restless hand trap, the seductive, deadly belief that your portfolio needs your constant intervention. It doesn't. Most of the time, the single most profitable thing you can do is absolutely nothing. Nothing at all. But inaction is terrifying when the market drops. So people act, they sell. They wait for things to stabilize, they plan to get back in at the bottom, and then they miss the recovery almost every single time because the recovery never telegraphs itself. It happens in a handful of trading days scattered unpredictably across a year, and if you're sitting in cash waiting for the all-clear signal, you miss them. Research consistently shows that missing even the 10 best trading days in a decade can cut your long-term returns by more than half. More than half. That is the clock restart penalty. Every time you interrupt the compounding process, you don't just pause the clock, you reset it back to zero. Back to the beginning of the curve, where it's flat, where it feels like nothing's happening, where the temptation to quit is at its absolute strongest. And the sneakiest part of all this? The motion illusion. The feeling that because you're busy monitoring, researching, reacting, you must be doing something useful. You're not. Activity and progress are not the same thing. Not even close. The speculator confuses urgency with intelligence every single time. The investor knows that the most powerful financial move is often the most boring one. Hold, wait, let the fortress compound, the inner saboteur. Now, here's where it gets uncomfortable, because the real enemy of patience isn't the market, it's you. More specifically, it's the way your brain is wired, and I say that with genuine compassion, not criticism, because these psychological patterns served our ancestors brilliantly. In the jungle, restlessness kept you alive. In the stock market, it will bankrupt you. The first barrier I want to name is what I call the busy fool syndrome. This is the phenomenon where anxiety masquerades as productivity. Your portfolio drops 5% in a week. Immediately, your brain generates urgent feelings. Do something. Research alternatives. Call your broker. Find an explanation. Make the uncomfortable feelings stop. That urgency? That need to act right now? It's not intelligence, it's cortisol. It's your fight or flight system trying to solve a perceived threat through motion. But financial markets are not threats to be fought or fled. They're rivers. The investor who learns to float on them, calmly, patiently builds wealth. The speculator who tries to fight the current, drowns, every time. Then there's the dead calm zone. This is the phase of the investing journey that quietly kills more portfolios than any market crash. See, the biggest excitement in long-term investing happens at the beginning, when you're motivated, getting started, watching your first deposits hit the account. And the biggest payoff comes at the end, when compounding is going exponential. But in the middle, in that long, flat, boring stretch where nothing feels like it's happening, where the market's trading sideways, your balance looks the same month after month, and every hot stock tip sounds more appealing than your boring index fund. That's the dead calm zone. And it's a test. The speculator fails it. They get bored. They get impatient. They rotate into something exciting. And in doing so, they abandon the position right before the curve starts going vertical. MC35, I've seen it happen dozens of times over the years. Heartbreaking every single time. Then there's the fear clock error. This one is subtle but devastating. It's the mistake of making permanent decisions based on temporary information. Selling a fundamentally sound business because of one bad quarterly earnings report. Exiting the market during a downturn that lasts 6 months, and missing a full decade of recovery on the other side. The speculator operates on the wrong timescale. They're running their long-term wealth on a 24-hour news cycle. The investor runs it on a decade-long horizon. Completely different game. Completely different result. And the last psychological barrier, honestly, this is the one that wrecks everything, is the abandoned protocol. Panic spending and quitting. When markets drop hard, something clicks in the brain. We feel the pain of financial loss more acutely than the pleasure of an equivalent gain. Much more acutely. And that asymmetric pain triggers liquidation, panic selling straight into the bottom. Then when the recovery happens, and it always does, most people don't get back in. Too scared, too burned, too convinced that the next drop is right around the corner, so they sit in cash. Inflation eats it quietly. And the fortress they were supposed to be building never gets built. Never. The market rewards patience and punishes urgency every single time. The watchful vault. Okay. So we've named the disease. Now let's talk about the cure. I call this the watchful vault, the concept of active patience. And I want to be very clear here, because people misunderstand patience in investing constantly. Patience is not passivity. It's not helplessness. It's not crossing your fingers and hoping for the best. Active patience is a posture, a stance. It's what I call the fortress stance, the aggressive defensive strategy. See, the disciplined long-term investor isn't doing nothing. They are actively maintaining their position under enormous external pressure. That takes more strength than trading. More discipline than reacting. It is genuinely hard, harder than most people ever realize. Most people will blink, and honestly, That's fine for the rest of us, because that's exactly where the opportunity lives. Now, here's something most financial content will never tell you. Real patience requires something painful. It requires trading ego for ammunition. The ego for ammunition exchange? Here's what I mean. The speculator needs to feel smart. They need a story at the dinner table. Yeah, I moved into gold right before the correction, or I got out at the top. That ego need, that deep need for a clever narrative, costs them a fortune. Because the best investing move is almost always the most boring one. And boring doesn't make for good dinner conversation, but boring compounds. Boring builds fortresses. Boring lets you sleep. The investor trades the ego story for something far more valuable: dry powder, ammunition, options, the freedom to act decisively when everyone else is paralyzed by fear. And that brings me to the inner thermostat, emotional regulation as a real practical investment strategy. Charlie Munger, a man I regard as one of the clearest thinkers of the last century, said that the key to successful investing is largely a matter of temperament, not intellect. You don't need a high IQ to build real wealth. You need a stable internal thermostat. The ability to feel fear and not act on it, feel excitement and not act on it. Sit with genuine discomfort without making impulsive decisions. That is a learnable skill. But only if you first understand that your emotions are information, not instructions. They tell you the market is scary. They do not tell you to sell. They tell you something exciting is happening. They do not tell you to buy. And ultimately, underneath all of this, the most powerful tool in the Watchful vault is the unbroken hold. Uninterrupted waiting. The refusal to abandon a position that your original analysis still fully supports. Buffett has held some positions for decades, not because he's lazy, because he understood from the beginning that the value was there, and that time, uninterrupted time, was the only mechanism that would fully surface it. The speculator sells the moment the market drops. The investor waits. They know the moat is intact. The fundamentals haven't changed. The only thing that changed is the price tag. And a lower price tag on a great business? That's good news. Not bad news. Good, the cooling chamber. Now, let's talk about practical architecture. Because discipline sounds great in theory. Emotional regulation sounds great in theory. But when the market drops 8% in a single day and your phone is lighting up with notifications, how do you actually implement any of this? You build what I call the cooling chamber. The decision distance protocol. The Fortress operating rules, a set of structural systems hard-coded into your investing life that create engineered distance between you and your worst impulses. Let me give you 4 of them. The first is the 72-hour lock. Simple rule. Whenever you feel the urge to make a significant portfolio change, sell a position, buy into a hot tip, reallocate, you wait exactly 72 hours. No exceptions. Write the idea down. Set a reminder. Revisit it in 3 days. You know what happens almost every time? The urge disappears. The crisis that felt urgent on Monday looks completely different by Thursday. The hot tip that seemed obvious at 11 p.m. after reading too many finance threads looks questionable in the clear light of Friday morning. The 72-hour lock is a simple gate, and it stops most bad decisions right there at the door. Right there. The second rule is the autopilot fortress, automated fundamentals. If your investing strategy depends on you making the right decision on the right day, while in the right emotional state, it will eventually fail because you're human. The bad days come for everyone. Automate the fundamentals. Set up automatic monthly contributions to your investment accounts. Set your asset allocation once and let the scheduled rebalancing handle the rest. Remove the human hand from the daily operation entirely. The right decision made automatically is infinitely more powerful than the right decision made occasionally. Infinitely. Third, the quarterly watchtower. Fixed review windows. Commit to reviewing your portfolio no more than 4 times a year. Set the dates right now: January, April, July, October, and outside those 4 windows. You don't look, you don't tinker, you don't react to the noise. Now, I know what you're thinking, but what if something big happens? Look, if something genuinely fundamental changes in a business you own, you will know. But 90% of the things that feel like emergencies in the moment, simply noise. The quarterly watchtower filters out the noise and lets you respond to actual signal only. Actual signal. And finally, the drawbridge protocol. Digital friction points: delete the trading apps off your phone. If you need to make a trade, you have to sit down at your computer, open a browser, log into the brokerage account, and go through the full deliberate process. That friction is a feature, not a bug. The easier you make it to act impulsively, the more likely you are to do it. The harder you make it, the more steps required between the emotional impulse and the actual transaction, the fewer bad decisions survive long enough to do real damage. Physical distance from the dashboard equals financial protection. Drawbridge up. All right, we're getting to the part I want you to write down, because everything we've covered, the compounding interrupt, the inner saboteur, the watchful vault, the cooling chamber, it all leads here. The fortress blueprint. The path to real, lasting generational wealth. The first principle is guarding the moat, protecting good decisions. Here's something most people never consider. They think wealth building is entirely about making great decisions. It is, but only partly. The bigger challenge, the harder work, is protecting the great decisions you've already made. You found a fundamentally sound business with a wide economic moat, a real, sustainable competitive advantage. You bought it at a fair price. You did the work. The decision is solid. Now, the real test begins. Protecting that decision from yourself, from the noise, from the fear, from the inevitable boredom that creeps in during the long middle game. The moat of a great business protects it from competitors. Your patience protects your decision from your own psychology. Both moats matter equally, both. Second principle, the compound skill stack. Building high-value skills. Wealth isn't built only in brokerage accounts. It's built in your brain, in your ability to earn, negotiate, create real value, and generate income worth investing in the first place. Compounding works on skills exactly the same way it works on money. Every skill you build makes the next one faster to acquire. Every capability you add opens new earning channels. The speculator ignores this and bets everything on hot stocks, hoping to shortcut the process. The investor invests in themselves consistently, patiently, and builds an earning capacity that makes the investing feel natural and easy. Build the compound skill stack. It's the bedrock of the fortress. Bedrock. Third, dry powder and armor, debt and buffer management. Consumer debt is the opposite of patience. It's impatience purchased on credit. Every dollar you carry in high-interest consumer debt is a direct drain on the ammunition you could be deploying when markets eventually go on sale. Clear the consumer debt first. Build a financial buffer, your reserve ammunition, of at least 3 to 6 months of expenses. Not because emergencies are certain, because a certain foundation is the precondition for patient investing. When you have that reserve ammunition, you can wait. You can afford to be calm. When you're living paycheck to paycheck, you cannot wait. You're forced to sell at exactly the worst possible moment. Forced to. The speculator has no buffer and no armor. The investor's armor is that buffer. Build it. Guard it. Never let it fall below the minimum. Never. And finally, the long vigil, holding during the boring phases. I keep coming back to this because it's precisely where almost everyone fails. The boring phase is not a gap in the process. It is the process. It's the period between when you plant the oak tree and when it casts shade, between when you lay the foundation and when the fortress stands complete, the period when nothing visible is happening, but everything important is. The market will test your conviction during the long vigil. It always does. It'll drop and make you feel foolish for holding. It'll trade sideways for months and make you feel like you're missing something better elsewhere. Hold anyway. If the business is still sound, if the moat is still intact, hold anyway. Because the investor who holds through the boring phases is the investor who captures the exponential phase on the other side. And the exponential phase, that's where the real wealth gets built. Real wealth, not the speculative kind, not the leveraged kind. The compounding kind, slow, inevitable, fortress grade. Now, one more thing before we close. And I want to be direct about this. If anyone out there is thinking that crypto, meme stocks, or the next hot trade is the shortcut around all of this, let me be very plain. That's rat poison. Dressed up differently every cycle, but the same thing underneath. Impatience with a marketing budget. The fortress is not built with shortcuts. Never was, never will be. Everything shared in this video is for educational and entertainment purposes only. This is not financial advice. Always conduct your own research and consult a qualified financial professional before making any investment decisions. In all my years studying this, and it's been a long time, I have never once seen a genuinely patient investor go permanently broke. Not through 2008, not through the dot-com collapse, not through the long shadow of 1929 that still echoes through every financial textbook written since. The patient ones always survived. More than survived, they accumulated. Because markets recover. Fundamentals reassert themselves. The companies with true moats, with real competitive armor, eventually earn their worth. They always do. The speculators are always hunting for the next catalyst. The next hot sector, the next narrative that explains why this time is different. The investor just waits and lets time do exactly what time does best. So here's what I want to leave you with today. The compounding interrupt is real. The inner saboteur is real. The cooling chamber works. The fortress blueprint is the map. But none of it matters if you can't do the most underrated thing in all of personal finance. Sit still. Sit still while the market screams. Sit still while your friends brag about their gains. Sit still while the headlines declare the end of the world. Because on the other side of that stillness is the wealth that actually compounds. The kind that doesn't keep you up at night. The kind that gets passed on. The kind that makes all the waiting worthwhile. Wealth is built in silence, lost in noise, guarded with patience. That's the whole philosophy. That is it. If this gave you something today, a new framework for protecting what you're building, do me one favor. Hit the like button. Leave a comment below. Tell me what is the hardest part of staying patient with your investments right now. Subscribe to Gaffer Wealth Mindset if you're serious about building a true financial fortress, not a house of cards. Because here we build slow, we build sure, and we build to last. A high IQ doesn't guarantee wealth, emotional stoicism does. I'll see you in the next one. Sleep well tonight.